Hey everyone, welcome to another video. I am going to cover 8 different dividend stocks in the video today. These are 8 dividend stock picks that I own in my personal portfolio, and they are absolutely crushing earnings. Well, at least 7 out of the 8 are absolutely crushing earnings. So I'm going to go through the earnings reports. I'm going to go through these stocks and why I think they're excellent dividend stocks and why I own all of them. Before I get started today, I want to do a shout out. Shout out to Gen X Dividend Investor. I'll link in the pinned comment below. Gen X has an amazing dividend stock investing channel, and I was inspired for the video today by him. I was actually inspired by his Twitter account because he recently covered all 8 of these dividend stocks on his Twitter. He shared the earnings reports for all of them, and that's how I got inspired for the video today. So make sure to head on over to Gen X. Again, I'll link in the pinned comment and subscribe to his channel. Also, before we get started today, just a friendly note. I am in my garage. It is very hot. It has been very hot out recently here in the Bay Area. And unfortunately, I'm sweating up a storm. And so the production quality of this particular video, it may not be the best in terms of my appearance, but I'm trying to get across the best possible content. And so please give me a thumbs up if you appreciate what I'm doing, sweating it out here in the garage while I produce this amazing dividend content. I love you all. Let's get started with an exciting video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to get started today with 3M. Check it out on the screen right now. 3M Company is one that I own. I love this company because not so long ago, there was an analyst that was saying it was going to go towards the same path of GE, General Electric. But obviously, it has not. It has done exceptionally well. 3M weathered the storm during the pandemic quite well, and now it's rebounding out of the pandemic. And they recently reported their second quarter 2021 results. And as you can see, their sales are up 24% year on year and 21.4% year on year from an organic local currency standpoint. And so this company is doing really well. The operating cash flow is $1.9 billion for the quarter, adjusted free cash flow of $1.6 billion, up 2% year on year, so not quite as good in terms of the growth, but still there. I love that they returned $1.4 billion to shareholders via dividends and share repurchases. Now, what's really exciting is they updated their 2021 outlook. Earnings per share, previously they were estimating would be $9.20 to $9.70 on the year. Now they're estimating $9.70 to $10.10. This is my favorite thing out of this earnings report, this quarterly earnings report from 3M, is they raised the overall earnings per share guidance for the year. And one critical takeaway at home when you're modeling your dividend stocks, you're thinking about buying dividend stocks and the price earnings ratios look high, and they should because they are really high. They may, though, not be quite as high as they seem because companies are rebounding really well out of this pandemic. And as they rebound, the guidance is going up. And so the PEs that we're all looking at right now, especially on a trailing basis, but even on a forward basis, they may be understated because the companies are, like 3M, accelerating so quickly that the earnings per share guidance is increasing. And so with that, I want to head on to the next stock. Check it out on the screen right now. And don't worry, after all of these, I'll do a complete summary of everything. But the next one is Apple. And so Apple is a dividend stock that I am really focused on growing my position right now. I want this to be one of my larger positions in the portfolio. And they announced their financial results for its fiscal third quarter 2021. And basically, they posted a June quarter record revenue of $81.4 billion. That's up 36% year over year. And their quarterly earnings per diluted share are $1.30. And so basically this company is just hitting the ball out of the park. It is doing exceptionally well. They generated $21 billion of operating cash flow. They returned nearly $29 billion to shareholders during the quarter, and I'm assuming that's through dividends and also repurchases. And one of the things I would say right there, we saw this in the 3M release. We saw this in the Apple release. Both of these companies are returning to shareholders value. And they're speaking to that. They're speaking, hey, shareholders, we're returning value to you either through repurchases or through dividends. And so these are shareholder-focused companies. These are companies that are focused on the shareholder, and they're saying that in the earnings reports. Those are the types of companies I want to own. I want to own companies that want to reward me, the shareholder, with dividends, with repurchases, because that's what it's all about. Of course, the companies want to fulfill their missions, but at the end of the day, I like to invest in these companies because they reward me, and eventually I can live off of all of the dividends. I'm already using the dividends to pay some of my bills. By the way, I now have the Apple Watch version 6. Here it is right here. You can see it on my wrist today. I am really, really excited about this new Apple Watch here, and I'm wearing it today in the video to celebrate Apple's success. And so I'm certainly a fan of Apple, both as a consumer and as an investor. And so I want to move on to the next one, my number one favorite dividend stock of all time. Check it out on the screen right now. This is Johnson & Johnson. And so Johnson & Johnson reported their Q2 2021 results, and they said strong sales growth, 27.1%. To 23.3 billion, and operational growth 23%, adjusted operational growth 23.8%, and wow, look at that, EPS of $2.35 increased 72.8% in the second quarter, and on an adjusted basis, 48.5%, and bingo, just like 3M, the company is increasing its 2021 full year guidance for sales and EPS. And so again, what I'm trying to say here is, yes, PEs look expensive right now, but at the end of the day, they're probably a little lower than they look for world-class companies like 3M, like Apple, like Johnson & Johnson, because the sales, the earnings are escalating. They're accelerating faster than the analysts can keep up, and they're raising the guidance. And so this is an exciting time. I think all of the financial stimulus, all of the dollars that have been printed, I think a worldwide recovery coming out of the pandemic. Certainly there are potential risks going forward, but it seems right now, honestly, looking at it fairly, that these companies are doing pretty darn well, and that's why they're trading at higher multiples. And so right now, personally, I'm going to get into the details later in the video, but I would feel comfortable buying 3M. I actually bought some recently, J&J, and Apple. So I want to get into one now that's not doing quite as good. This is Kimberly-Clark. Check it out on the screen right now. And so this is the one earnings report today that I'm going to go through that is not so bright. And basically in the second quarter of 2021, their net sales increased 2% compared to the year ago period, but organic sales declined 3%. And it says that diluted net income per share was $1.19 versus $1.99. And so it's way down. Second quarter adjusted earnings were $1.47 versus $2.20. And so adjusted earnings exclude certain items. And so basically this is a company that is not doing as well as last year. And that makes sense. Kimberly-Clark sells toilet paper, tissue, basic items that everyone was stocking up on during the pandemic. And a lot of people right now have more than enough. They are still going through their stock from last year. And so basically what's happening is sales and earnings are slowing down. One other dynamic at Kimberly-Clark that they talk about is input costs are higher, inflationary pressures. And so they're trying to pass that along to the consumer to expand and to keep and to maintain their strong margins. And so one of my biggest takeaways from this is I love Kimberly-Clark, and I'd probably still be a buyer here, although I'm not as excited about it. We'll get to that later as compared to some alternatives, because I can get some alternatives that are growing quicker for a similar PE, price earnings multiple. But what I would say about Kimberly-Clark, what's exciting is every player on the team plays a role. And I own a lot of different stocks, 51 stocks, because they all counterbalance each other. Whereas Kimberly-Clark was doing really well last year, another company like 3M, it was a little bit more sluggish, and so they kind of counterbalance each other. Now 3M is doing really well. Kimberly-Clark, it's a little soft, it's a little weak, and so it's okay. They're just in different market cycles for those specific companies. And so that's what's going on, but they're all members of the team. All right, I want to keep going. Check it out on the screen right now. And so the next one is Coca-Cola Company, and they're reporting strong results. They updated their full year guidance. This is becoming a theme, everyone. Full year guidance is updated. They're raising the expectations for how much money they're going to earn this year. Global unit case volume grew 18%. Revenues are up 42%. Organic revenues 37%. Operating income is up 52%. Comparable currency neutral operating income, that's an adjusted number, non-GAAP, grew 46%. Margins are stronger than they were in the prior year. EPS is way up 48%. Even comparable EPS, the non-GAAP measure, is 61% stronger. And so Coca-Cola is doing extraordinarily well. And it's exciting to see that. Now, when we look at the stock later, you'll see it's also trading at an extraordinary multiple. So I'm not necessarily a buyer here. I would be a buyer of Johnson & Johnson, 3M, Apple, maybe Kimberly-Clark. I'm not so certain about Coca-Cola. It's pretty expensive, but we'll get more to that later. But as someone who owns the company and is reinvesting my dividends on Coca-Cola, it's one of my favorite stocks of all time. I feel really pleased to see the strong performance, and it's doing well even after the pandemic. And quite frankly, I think it did all right during the pandemic when everyone was at home enjoying Coca-Cola products. Let's keep going. Check it out on the screen right now. Another world-class dividend stock as I sweat it out here in my garage for this video, McDonald's. And so McDonald's reports second quarter again, just like these other companies, and global comparable sales were up 40.5%. Now, this is what I love about McDonald's. They make it really easy for the analysts like myself. They show also the 2-year basis, because we know last year was an anomaly. Last year was a weird year. And so on a 2-year basis, they're saying that the global sales are up 6.9%. So they're up 6.9% from a pre-pandemic level. And that is amazing. Comparable sales increased on all segments on a 2-year basis. And year-to-date system-wide sales from digital channels are up nearly $8 billion, a 70% increase. And so they go on to say below, they show U.S. up 25.9% from a sales standpoint, 14.9% on a 2-year basis, which is what I love, even doing better than pre-pandemic. International, 2.6% on a 2-year basis. International developmental licensed markets, 0.3% on a 2-year basis, so on and so forth. And so what I would like to summarize from McDonald's is 2 things. One, I love the management team there for looking at things on a 2-year basis. That is the way to look at it. It makes things better, easier for people like myself to understand. I love that things are increasing globally across all segments, and I especially love to see the digital sales. McDonald's, is it just a real estate company? Is it just a fast food company? Or is it a technology company like Apple? In some ways, it is a technology company. They opened a Silicon Valley office. And so what I would say is, and they made all these acquisitions in technology. This is a tech-focused company, and we're seeing that now through that 70% growth in their tech-related to-go order type business. They call it system-wide sales from digital channels. And so that's really exciting to see. Let's keep going, everyone. Check it out on the screen right now. Next stock I want to cover today is some amazing earnings as a dividend investor. Boy, I'm excited about this one. Shout out Darth Dividend if you're watching, my friend. This is one of his favorite stocks as well, PFIZER. PFIZER is just hitting the ball out of the park, and it's still trading at a bargain basement PE. And so as you can see on the screen right now, PFIZER reports their second quarter results. And wow, revenues were $19 billion, reflecting 86% operational growth. And even if you exclude BNT162b2, which is the vaccine, revenues still grew 10%. Oh my goodness. The 10% growth, excluding the BNT162b2, builds on the 6% operational growth delivered by the comparable businesses in the second quarter of 2020. So this company is growing with the vaccine or without. It is growing. It's doing really well. And second quarter diluted EPS of 98 cents, adjusted diluted $1.07. Oh boy, here's another trend. They raised their full year 2021 guidance for revenues. They're raising it to a new range, and they're raising their adjusted diluted EPS range as well. And they're raising these ranges. It seems these are reflecting updates to the outlook of the business, both including and excluding BNT 162b2. And so basically, you also see in here that there are some exciting updates as well around the vaccine. They're working on a broader portfolio as it pertains to vaccines. This company is firing on all cylinders, and the stock price is starting to go up, but the stock price is nowhere near where it should be given what they are doing, in my humble opinion, and where at the level at which they are operating. In many ways, it reminds me of AbbVie a few years ago when it was trading really cheap. And so I'm excited about Pfizer. I love Pfizer. I'll be buying more shares. We'll get to the specific statistics in a minute. But first, check it out on the screen right now. I have one more stock to go through. So the next one is Starbucks. Boy, Starbucks is doing well. This is one of my favorite companies of all time. And Q3 consolidated net revenues are up 78% to a record $7.5 billion. Q3 comparable store sales up 73% globally. US is up 83%. And they do it like McDonald's. They're showing 10% 2-year growth. So they're growing even as compared to the pre-pandemic level. And so it goes on and on. Q3 GAAP EPS was 97 cents, a record non-GAAP of $1.01, driven by strong U.S. performance. China surpasses 5,000 stores. Global store count is now 33,295. And membership of the Starbucks Rewards is insane. It's up 48% year over year. So what I would say about Starbucks is two things. Like McDonald's, they're up on the 2-year period. This is really important because a lot of analysts out there are saying, hey, it's exciting, we're seeing all this growth, but it's going to be really hard. It's really easy to have growth because everything was kind of suppressed so much. But my takeaway from a lot of this is, yes, it is kind of easy to have growth because we're exiting this period of pandemic, but it's not so easy to beat the 2-year ago period, and that's what's happening with McDonald's and Starbucks, so it's really exciting to see that. What I would also say about Starbucks is, like the watch, like Apple, this is a tech company in many respects, and so I really like that about Starbucks as well. Their rewards program, their membership program, their app, it is growing really, really fast, and they are busting through records, and so this is why I was buying Starbucks stock during the pandemic, because I foresaw that this kind of scenario would happen, because just the demographics as they play out, this is what the younger generations want. I see it before my eyes every single day. It's what the older generations like myself want as well, and I see that play out before my eyes every day. I have one more slide on Starbucks. Check it out on the screen right now. And so the next one I have for Starbucks just gives some highlights, and you can kind of peruse this at your own time. What I want to say, though, is the one line that says the company opened 352 stores, and they keep opening more stores. This is really important. I remember there was a headline like a year ago or a while ago, oh my gosh, Starbucks is closing stores. And everyone was panicking, saying, hey, Starbucks, it's over. They're never going to do well. Why are they closing stores? They only closed like 100 stores or something, 150. The reason they close stores is they're optimizing their portfolio. They're always testing new locations. Some locations will work, some won't. And so when you see news that Starbucks is closing a few hundred stores, in my opinion, that's not something to get alarmed about. That's business as normal. That's just optimizing the portfolio. If you see them closing a few thousand stores, then I would start to look into it deeper. But basically, that's just part of business as normal. And so I wanted to show here they keep opening new stores as well. They're going to test these new locations. With all of that, let's look at the financials. Check it out on the screen right now. I have a consolidated view of everything. And by the way, if you're on my Patreon, I linked to that in the pinned comment below. Check it out. If you're not on it, there's two levels, $3 a month, $10 a month. $10 a month gets all of my dividend stock analysis. $3 a month gets all of my videos, and $10 a month gets that too. I have 41 videos on there now. You can cancel at any time. You get access to all 41. I just uploaded a new video today. The patrons over there love it. You may want to go check that out. It is really awesome. And again, I linked to that in the pinned comment below. And before I get into the analysis today any further, please go ahead and smash that like button. It really means the world to me. It helps this channel get to more people. I'm literally sweating it out here in the garage trying to put this content together. And you may wonder, Ian, why do you do these videos in your garage? You would be surprised. In the Bay Area here, there's just, the homes are smaller. It just is what it is. And so right now, both of my kids are sleeping. I don't want to be too loud in the house and wake everyone up with my video. And so it is what it is. And that's why I'm here in the garage tonight. But I do appreciate it. All of the thumbs up. And also, if you could go ahead and subscribe, because I want this knowledge to reach as many people as possible, because I think it's really important. It's really fundamental. I think dividend investing is one of the best strategies ever. So check it out again on the screen right now. And what you see is all of the stocks. I've got all 8 of them right here in one table. I highlight the cells that are interesting to me. And what I'd like to share really quickly is just one by one. What do I like about 3M? I like the fact that the PE is 18.76, not this year, but next year. I like that the dividend yield is 3%. Now, with them raising EPS guidance, I think these PEs are probably a little overstated. I think they will possibly be a little lower than they are. And in the overall inflationary environment we're in, and given that we're rebounding out of the pandemic, they have a reasonable payout ratio. They have a good starting yield. I'm still a buyer of 3M here, especially below 200. And so that's 3M. Apple, honestly, it's kind of expensive on a PE basis, but not so expensive when you consider the growth. One of the things I like about this table is look at Coca-Cola, similar PE range to Apple. Look at McDonald's, similar PE range to Apple. But we know Apple is probably growing quicker than Coca-Cola and McDonald's. And so of those three, I would rather buy Apple than McDonald's or Coca-Cola right now. Now, what I love about Apple is whereas the dividend yield is low, their payout ratio is really low at 17%, and their compound annual growth rate on the dividend is 9.1% on average per year. I am a buyer of Apple here. I really do want to add more, and that's strategic for my portfolio as well to get more tech in the portfolio. J&J, I like that the forward PE this year is an 18, next year is a 16.5. I love their PE. I love their payout ratio, which is only 44.5%. A lot of room to increase the dividend, although they've been raising it a little bit slower, only at 5.8% per year. And so I'd like to see the pace at which they increase the dividend accelerate a bit. But there's a lot to love about those PE ratios right here, and the payout ratio being lower and being such a world-class company. So I'm a buyer of J&J here. J&J, Apple, 3M, I like all of those. Out of the three right now, just for my portfolio, I'd probably get most excited about buying Apple. Kimberly-Clark, the only thing I could get super excited about is that dividend yield of 3.4%. That's a great starting dividend yield in this market. The PE ratios are also good, but the reason I don't highlight them is this company just ain't growing as quickly. And so you look at something like Kimberly-Clark versus J&J, you could pay a similar PE for Kimberly-Clark, but it doesn't have the growth of J&J. It's not a growing business right now, at least this year. And so that's something to keep in mind. I think a lot of people in the dividend community, they noticed that Kimberly-Clark dropped. And I think a lot of people, myself included, when a share price drops, we want to buy more. But also, I just want to be honest with myself that, hey, yeah, the share price dropped, but also it's not that cheap. I think it's fairly priced. Maybe it's even a little overpriced as compared to some other values in the market like Johnson & Johnson. Let's keep going. Check it out on the screen right now. And obviously, don't get me wrong, I love Kimberly. I really do, and I probably will buy some more. Coca-Cola is expensive at a PE of 26, 24 next year, so I'm not really a buyer here. I'd say the only thing that gets me really excited about Coca-Cola here is the starting dividend yield of 3%. That does come at the expense, though, of payout ratio. Payout ratio is quite high, and so they're not retaining a lot of their earnings. They're paying them out. And so that gives them less money to innovate the business. And so there's pros and cons. And their compound annual growth rate on that dividend is quite low. And so I'm not super excited about buying Coca-Cola here, but I'm glad I own it, and I'm glad to see that the business is thriving and growing really quickly. Eventually, these numbers will catch up. And one of the things, that's actually a huge point from the video today. A lot of investors try to time the market, and a lot of investors get upset at themselves when they bought too high or they paid too much for something. But the fact of the matter is, with world-class companies like Coca-Cola, sooner or later the numbers will catch up with the price that the investor pays. I can't say that that will always happen, but with the best companies around, it seems like that happens more often than not. And that's what's exciting about Coca-Cola. Yeah, it's expensive here, but the numbers are going to catch up because it's growing so quickly. Let's keep going. Check it out on the screen right now. And so the next one is McDonald's. McDonald's trading at a PE of 28 this year, 25 next year. Quite expensive. I'm not a buyer here. Starting dividend yield of only 2.1%. I don't think there's too much to get excited about here, other than that massive dividend compound annual growth rate of 7.7% per year. That's above my preferred target of 7%, so that's nice to see. And payout ratio is all right, not too high. So let's see. Maybe they'll keep increasing the dividend. I would say PFIZER I'm super excited about here. The PE is only 11. 12 next year, I think it'll actually be a lot lower than this. I think the analysts are underestimating what's happening with these vaccines. I love the starting yield of 3.6%. I love the payout ratio. And whereas the dividend compound annual growth rate is not that high, they have room to accelerate that over time. It will catch up, in my humble opinion. But even if it doesn't, the starting yield is pretty good. And I love the value here with PFIZER, both with the vaccine and even their core business without the vaccine is growing just fine. Starbucks is expensive. There's no doubt about it. Premium for such a world-class company with a PE of 41 this year, 34 next year, starting yield only 1.5%. I can't really highlight much here other than that dividend growth rate, compound annual growth rate of 17.6% per year on average. And so that's exciting. I'm not buying Starbucks here. Long story short, out of all of these stocks, what really excites me for my personal positions and my personal strategy right here is Apple. I would say that one excites me. I would say PFIZER excites me. I would say 3M excites me. J&J excites me. Maybe Kimberly a little bit. Coca-Cola, McDonald's, Starbucks, not as much. But all 8 of these are absolute world-class, best of class companies. And so I would love to know in the comments below, what do you think about these earnings reports? Do you follow the earnings reports? Do you kind of take a more passive approach? What do you think about these 8 stocks? I would love to know. Again, everyone, I'm on Patreon. I'll link to it in the pinned comment below. Please go ahead and smash the like button if you enjoyed the video today. And before I go today, in terms of a full disclosure, I am long the stocks mentioned today. I am long 3M, ticker MMM. I'm long Apple, ticker AAPL, Johnson & Johnson, J&J. I am long Kimberly-Clark, KMB, Coca-Cola, KO. I am long McDonald's, MCD, PFIZER, PFE, and Starbucks, SBUX. I own all of those stocks in my personal dividend stock portfolio. Before I leave, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go and invest money in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a lot of money in the market. All right, everyone. I look forward to seeing you in the comments below. I hope you have an amazing day. Thank you for your support here. Please share the video with a friend if you found it valuable, and I'll see you in the next dividend investing video.